Hey guys, welcome back to the channel. In this video, we will take a look at the VWAP indicator, which is a special indicator when compared to other available indicators in the market. This will be a very informative video, so do watch it till the end. And if you haven't subscribed to the channel yet, please make sure to subscribe. Well then, here is what we will discuss in this video. We will talk briefly about VWAP and the basic information related to VWAP. Then we will move on to understanding why VWAP is better than other technical indicators. Then we will have a brief discussion on the core concepts of VWAP. We will also be talking about the uses of VWAP and the importance of VWAP bands. Not to mention, we will also discuss about the disadvantages of using VWAP. And finally, we will wind up the video with 3 VWAP strategies that you can use to trade in the market. So without wasting any time, let's get started. VWAP stands for Volume Weighted Average Price. VWAP is commonly used as a benchmark indicator, and it is derived from a ratio of average share price for a stock when compared to the total volume of shares traded over a particular time frame. The indicator is most commonly used by short-term traders and algorithm-based trading programs. The indicator helps analysts and traders evaluate the current price of a stock and determine whether it is relatively overpriced or underpriced compared to the average trading price for the day. What makes VWAP so popular is that it is used to measure the trading performance of smart money or large institutions. Professional traders who work for investment banks or hedge funds are required to trade large numbers of shares each day. So they cannot enter or exit the market by simply buying or selling a large position at any given prices. So these institutional traders compare their prices to the VWAP values. So when a buy order is executed below the VWAP, it would be considered as a good order filling because the stock was bought at a below average price, meaning that the trader has bought their large position at a relatively discounted price compared to the price that is available in the market. So VWAP was and is used by institutional traders to identify good entry and exit points in the market. On the other hand, when a professional trader has to get rid of a large position, they try to sell the position at a price which is higher than the VWAP price. So in short, what we can understand is that VWAP is an intraday indicator that can be used to help investors decide whether to adopt an active or passive approach to enter their positions. So many traders also use VWAP to help them buy at a relatively inexpensive price and further sell them at a comparatively higher price. Now let us briefly look at how VWAP is calculated. VWAP is calculated using the opening price for each day and adjusting in real time right up until the close of the session. Therefore, the calculation uses only intraday data, and the formula for calculating VWAP is as follows. VWAP is equal to cumulative typical price multiplied by volume, the whole divided by cumulative volume. Now, the breakdown of this calculation is quite extensive and which is not great use for us. So rather than dwelling deep into these calculations, we will try to focus on the application side of this indicator. Since the VWAP calculation is based on historical data of price and volumes, it is considered as a lagging indicator. But this does not stop traders from using this indicator to establish support or resistance level, which is suitable for intraday trading. And on top of this, because institutional traders use VWAP as a benchmark for their execution activity, VWAP price level is considered to be highly influential in the intraday price action. Now let us see why VWAP is a superior indicator or what is the significance of VWAP. Now VWAP combines price and volume together in its value. Therefore, analysts consider VWAP to be a more true representation of the average price of stock. One of the most important features of VWAP is that it is cumulative in nature, while most technical indicators are periodic in nature over the recent number of candles. To understand this simply, think about a chart as a painting, which is drawn candle by an artist. Imagine if you could only see the last 9, 10, 20 or 50 candles made by the artist on the chart, while everything before that disappears from the view as he continues painting. How would that feel? You will not get the feel of the entire picture, right? So this is the same problem with periodic indicators. Data from beyond the arbitrary look-back period you have selected is no longer factored into the calculation. Which means if you have selected a 9 EMA or 20 SMA, only the previous 9 bars or the previous 20 bars are considered for calculation, which leaves you with an incomplete picture of the market. Now when it comes to VWAP, its cumulative nature allows you to see the entire painting develop over the course of the day while factoring in each and every candle. And no piece of data gets left behind, which leaves you with a realistic picture of the market. Moreover, VWAP isn't susceptible to changes in length, type, or time frame, unlike moving averages. What this means is that, in addition to providing an increased context, the cumulative calculation of VWAP prevents confusion regarding the selected chart timeframes and indicator settings that exist in nearly every other piece of technical analysis indicator. It doesn't matter if you use VWAP in a 1-minute chart, an hourly chart, or anything in between. There is only one intraday VWAP. It does not change with time frame because the factors that were taken for calculation was just the price and the volume. So flipping between the time frames will not affect the calculation and the calculation remains constant. The same can't be said for periodic indicator. For example, a 20-period moving average on a 1-minute chart will look drastically different than what it would look like in a 1-hour chart. There are a few core concepts that are associated with the VWAP indicator. Number one is that VWAP behaves like a magnet, which means it either attracts or repels. So our main objective should be identifying the market style. That is, if the price is moving towards the VWAP or away from the VWAP. There is this myth in the market that price is always attracted towards the VWAP. But this is not true in every case. And such an interpretation will lead to an oversimplified approach when using the VWAP. If we go by this approach, shorting stocks that trade too far away from VWAP and buying those that fall too far below the VWAP, with the exception that a reversal is imminent. So if these conditions were true, we would never witness sustained trends or uptrends or downtrends in the market. Now the reality is that price can either be drawn towards the VWAP or it can be actively repelled from it. So you have to understand this magnetism concept associated with VWAP, or else you will find yourself trading in the wrong side of the market and thereby making a loss. Now the second concept associated with VWAP is that VWAP has inertia, or in simple words, it has the tendency to continue whatever it's doing. Now what this means is that we have given volume the equal weight in calculation of VWAP. So VWAP is intuitively more responsive to price movements on significant volume. So as VWAP absorbs more price and volume data over time, it becomes more resistant to random oscillation and sudden shifts. So this allows it to accurately reflect only meaningful changes in the market's value, and it increases its credibility as a reliable reference point. This is what is meant by the inertia of VWAP, where its resistance to change make it significantly more reliable than other short-term indicators which randomly gives out buy or sell signals every couple of minutes. Moving on, let us discuss some of the important uses of VWAP. Number one, VWAP can be used to determine the market trend. So for bullish trending days, the market usually stays above the VWAP. And for bearish trending days, the market stays below the VWAP. And for ranging sessions or ranging days, the market stays almost around the VWAP indicator, which remains more or less flat. Now, these observations show that VWAP has a great potential for helping traders identify the market tide during an intraday activity. Another way of determining the market trend using VWAP indicator is by paying attention to the slope of the VWAP. So in a trending session, the slope of the VWAP will stay positive or negative throughout the session. On the other hand, when it's a ranging market, the market fails to move away from the VWAP and the VWAP will have a relatively flat slope, meaning that there is not much trending action. Now the second use of VWAP is that it can be used as a support or resistance zone. When price is above the VWAP line will act as a support. On the other hand, when the price stays below the VWAP line will act as a resistance to the price. Now the third and final use of VWAP is that VWAP shows who is in control or who is the dominating force in the market. So when a stock is traded above the VWAP, it means that buyers are in overall control of the price and there is a buying demand on the stock. And when a stock price breaks and closes below the VWAP, it is safe to assume that the sellers are gaining control over the price. So in short, when VWAP is rising, then buyers are in control. If VWAP is falling, it shows sellers are in control. And if VWAP is flat, then it indicates that no one is controlling the market and the price is in a trading range. The VWAP bands or the standard deviation bands associated with the VWAP indicator can save your money big time. So the idea of just buying when the price is above the VWAP and selling when the price is below the VWAP is drastically oversimplified. So in order to make meaningful trades, we can make use of standard deviations in association with VWAP. Now standard deviation in short is a statistical tool which is used to quantify the variance in a dataset. Now by applying this standard deviation tool to trading with VWAP serving as the average line, we can plot these deviations as bands, an upper band and a lower band, to create a visible unit of measurement and characterize the market movement within these bands and also to gauge the volatility. Now this looks like a Bollinger Band, but trust me, this is better than a Bollinger Band, because in Bollinger Bands the average line is a moving average. But in case of VWAP, the average or the mean line is actually a VWAP line, which in turn is an average value generated from the calculation of prices and volumes. So it holds more weightage than a moving average. Now you can find this VWAP indicator with bands in the TradingView site, and the deviation bands are automatically plotted and it gets adjusted as we receive more data throughout the day. If you look at it, at the market open, they typically start off small and then expand as the price begins to break away from the market average. The rate at which these bands change depend upon how far the price is away from the VWAP and how much volume is being transacted to. So applying VWAP and the deviation bands to a chart creates a grid-like system which allows you to categorize the market activity into different zones. And each region has unique characteristics and different expectations. What this means is that it helps you identify if the market is good enough to go long or to go short, or if there is no identifiable trend. This will in turn allow you to have a superior reframing on how you look at a chart. Now I have mentioned about the 4 zones that the VWAP would generate. The first zone is above VWAP, but it is beyond the first standard deviation, and in this case the market is expected to continue uptrending. If the price is above VWAP but it stays between the VWAP and the first standard deviation, then it is expected to oscillate around the VWAP. Similar is the case when the price is below the VWAP and it is between the VWAP and the -1 standard deviation, then the price is expected to oscillate around the VWAP. And finally, when the price is beyond the VWAP and it is lower than the -1 standard deviation, then the market is expected to be downtrending. Price crossing between these VWAP zones is also a noteworthy event because more often or not, there is some sort of a resistance when the price crosses these zones. These zones expand when the price sustains a trend and it contracts when the price consolidates towards the VWAP. Now moving into the disadvantages of VWAP. VWAP is a lagging indicator because VWAP is more sensitive to price and volume changes at the beginning of the session, but it becomes less responsive as the session progresses. This is called as progressive lag. Due to this progressive lag, VWAP might not be an appropriate indicator for timing the market entries. Or in other words, it requires a supporting price action for entry, or knowledge about price action is very essential while using this indicator. Another shortcoming is that it can be only used in the intraday time frame only. If you try to use it for more than a day, it will not be able to portray the correct trend. And it cannot be used at the opening of the day, meaning that VWAP will be in line with the price and it will only expand or move away only when the session proceeds. Now finally, let's talk about the strategies. In this video, we will talk about 3 strategies. Number 1 is a pullback strategy. Number 2 is a reversal strategy. And finally, a mean reversion strategy. Now, a word of caution before using VWAP strategy is that you should avoid trading VWAP at the opening of the trading session, which means after the market opens, the price bars tend to overlap the VWAP. So in the first 5 minutes, due to heavy trading happening in the market, you cannot judge the market bias until the market tries to move away from VWAP. So after volatility decreases around 10 to 15 minutes into the open, the stock price will move towards or away from the VWAP. So you should stay out of the markets until the prices diverge sufficiently from the VWAP. Now I'm going to give you some general conditions before taking a trade. Number 1, do not try to go long when the price is below the VWAP, and do not try to short a stock if the price is above the VWAP. But there is a catch. If the prices are extended way far from VWAP, then a reversal is okay or a mean reversion is okay. But the target has to be set as the VWAP line. We will discuss the mean reversion strategy soon enough. Now, most important point, use VWAP indicator with price action and volume. The first strategy that we'll be talking about is the VWAP first pullback strategy. Now, this strategy should be used in trending market. Let us take a look at this strategy in terms of an uptrending day. So the first step is to find out if the stock is in a clear uptrend or a downtrend, depending upon where the price is with respect to the VWAP line. After that, you need to look for at least 2 to 3 candles in the same direction above the VWAP. After that, you have to wait for the price to approach the VWAP line for the first time. That is, a pullback to the VWAP should happen, and then look for a push away from the VWAP line. What this means is that the price should not stall at the VWAP or consolidate. Rather, it should push away from the VWAP. You can also look for a deep rejection from the VWAP line. And finally, observe that if the upside push follow through higher, or is it rejected back to the VWAP level from the previous swing high level in case of an uptrend. And if the price manages to break above the previous high, you can take a long entry or initiate a buy order, keeping a stop loss below the rejection candle. And when the move turns out to be in your favor, you can keep a trailing stop loss below the VWAP line with suitable buffer. You can exit the trade when the price moves below the VWAP line or hits your trailing stop loss. The same strategy can be used in downward trending markets also, just by changing the rules. Now the second strategy is a reversal strategy. In this case, we will talk about a VWAP reversal towards the upside. Here are some of the criteria of this strategy. The previous day should be an uptrending day or a bullish day, and the price should not close below the last swing low. Now we will draw a horizontal line from the VWAP level of the last candle of the previous day, and we can name this as the PVWAP level. For a buy-side trade, the price should close above the VWAP level. Look to see in the morning if the price moves into the previous day VWAP or the PVWAP level. The volume of this move is also important. Preferably, low volume move is the best. The price opens and moves down with lesser volume and stalls at the PVWAP level and is unable to close below the PVWAP. This is very important. That is, the price should not close below the PVWAP. Look for a push away from the PVWAP level. If the upside push follow through higher, then look to take a long entry or initiate a buy order. It is best if we make use of price action. We will take the trade only if we get a good entry and good risk to reward ratio by keeping the stop loss below the PVWAP level, and when the price moves in your favor, keep a trailing stop loss below the VWAP level with suitable buffer. You can also make use of the VWAP's upper band to book your profit. That is, when the price reaches the upper band, you can exit the trade. Now the last and final strategy is the mean reversion to VWAP from the standard deviation band. This is a very useful strategy that can be used in ranging markets or when the price is very much overextended from the VWAP level. The idea is to take a buy or a sell entry from the second standard deviation band, keeping the VWAP line as the target. Now you may ask why the second standard deviation band and not the third band or only the first band? Now the answer is very simple and can be explained using the normal distribution curve, where a single standard deviation band above and below the VWAP will cover only 68% of the price move, while the second standard deviation band encompasses more than 95% of the price move. Even though the third standard deviation bands predicts over 99% of the price moves, but such moves are rare in occurrence, and so you might not get a suitable entry as the price might return to the mean line before testing the third standard deviation bands, which means you will not get a lot of trades if you use the third standard deviation band. Now the trade idea is simple. We will wait for the price to test the second deviation band, either from above or below the VWAP line. Now keep an eye on the price action formed. If the candle formed at the band shows some sort of a rejection and then goes on to form a reversal candlestick pattern. For example, if the price is at the lower standard deviation band and the price rejects lower prices and forms a hammer candlestick, this can be a confirmation for taking a long entry if the next candle crosses above the high of the hammer candle. Now the strength of this strategy is higher when the reversal happens near an area of value like a support or resistance where there is enough liquidity for the move to happen. The stop loss for this trade would be below the hammer candle or below the support level in case of this example. For a short trade, the setup is similar, but we have to look for a rejection from the upper VWAP band and look for a bearish reversal candlestick, more preferably near a resistance level. The stop loss can be placed above the rejection candle or above the resistance level with suitable buffer. The target in both these setups is the VWAP line itself. The primary goals of technical analysis in trading is to identify a probable trend or a counter trend that is expected to continue and then provide a suitable entry at the trade at a credible support or resistance level with a predefined risk. And further monitor the likelihood of the continuation or a reversal to optimize your exit. Now if you ask me, VWAP meets all these criteria. The VWAP along with the band system helps you to forecast the market direction and also predict the dynamic supports and resistance level, thereby giving clear-cut risk levels that we can use both initially to enter the trades and also to actively manage them as we progress with our trade. Now, VWAP in no way is the holy grail to trading, but it has got some exceptional utility. The thing is, it won't save you from undisciplined trading. VWAP is a superior indicator and it is recognized by institutions. So I recommend you to put more effort into learning this indicator and applying it to your charts and backtesting the data to see if it actually works for you. I hope this video was informative for you, and if it added some value, please do like the video. Do not forget to subscribe the channel and press the bell icon so that you won't miss out on the upcoming videos. I'll see you guys in the next video. Till then, bye.